Okay.
Welcome everyone. Our 8th webinar. We're super happy to be doing this again. Today we're talking about a great topic. We're doing interest rates, the economy, GIC rates, and kind of investing in this new COVID-19 market. And we're super excited because we have CEO and President Paul Sandu from Merit Asset Management on the line, and he's going to talk to us and answer all these questions that you guys want to know answers to. Again, obviously this is for educational purposes, so please bear in mind that you will not be getting any stock picks or anything like that today. So a little bit about us at Patel Wealth Management. We started back in 1981 by my father, who used to be a stockbroker, basically buying and selling securities and taking commission for doing that. Obviously, our business has changed so much since then. We've gone from the stock brokerage business to the full wealth management, where we do planning, investing, educating, protecting, lending, everything that has a dollar sign, basically. A little bit about myself. My name is Sheen Patel. I am the Associate Investment Advisor on the Patel Wealth Management Group, and my job is essentially to do all of the wealth management side of the business, and Schick takes over most of the investment side of the business. And of course, we wouldn't be able to do this as a two-person team. We actually have a ton of people on our team and partners like Paul that help us out on a daily basis for our clients. So without further ado, let me send it over to Paul, and Paul, you can introduce yourself.
Well, good afternoon, everybody, and thanks, Sheehan, and please thank your dad as well for having me. I really appreciate it. I'm the Chief Investment Officer at Merit Asset Management. Merit Asset Management is essentially a specialty fixed income firm. That's all we do. Focus very on the bond market. We specialize in corporate bonds, so therefore, we obviously look at corporate bonds anywhere from the highest quality, which would be AAA rated, all the way down to the lowest rated, which would be triple C rated. People would think about that as investment grade bonds, which are very high quality, and of course high yield bonds, which are lower quality. Now, all of our funds are very flexible, including some of the ones I think that you guys have positions in now for some of your clients, in the sense that even though we focus on corporate credit, that doesn't mean we have to be invested in corporate credit. Our funds can be 100% government bonds, they can be 100% cash, and they can be 100% corporate. So we are what you would call active managers. So as we see, the world economies evolving, as we see interest rates evolving, as we see the economic cycle evolving, we might change the mix of our fixed income investments to position our funds to where we think the best returns might be for our clients, as well as potentially sometimes the best safety and capital preservation for our clients. So that's when you look at Merit funds and various Merit funds, you can think about it as us as an active fixed income manager with lots of flexibility in all of our mandates.
Awesome. And Paul, why don't you touch on your background too, where you went to school? Because fixed income and a whole nother beast, and every time I talk to you, it's about interest rates or economics or politics or whatever. So why don't you tell our crowd a little bit about your background?
Yeah, I'm actually born and raised in British Columbia and educated. So I did my undergraduate degree in political science and economics at UBC, and then I completed my master's degree at the University of Victoria in public administration. Once I finished my degree, I actually went to work for the investment department at the province of British Columbia. That's the department that manages all of the pension funds for BC. So this would be like the teachers pension fund, the public service pension fund, the municipal pension fund, all that sort of stuff. So a very large investor, which at the time, this is going back quite a few years, was almost exclusively invested in bonds. So obviously I got a pretty good upbringing in the bond market and generally in investing there. I've subsequently have worked in not only Canada, but in the UK and in the US. So I also did a part of my career on what we call the other side of the street, on the south side. So I did work actually for Goldman Sachs. I worked for Salomon Brothers when it was still Salomon Brothers. And keep in mind, I'm not in the book, so don't look for my name in the book. Everything's good. And I've also worked for BMO Nesbitt Burns in the UK, in the US, and here in Toronto, which is where I am today.
Yeah, that's quite the background you got there, I must say. Now, a lot of our viewers are actually Hamilton based. I think you have a little bit of a footprint here in Hamilton. Maybe you just touch on that really quickly, if you would like to.
Well, my family and I, and this is really kind of more the brainchild of my son, or one of my sons. We have a craft brewery here in Hamilton, and we're about 3 years old now. We built a brand new building on James Street And the brewery's been doing really well even through this period of COVID. Unique sort of concept. We're really proud to be in Hamilton, and by the way, that's my son who really had the vision to basically create this craft brewery in Hamilton. It's got a great reputation. When we first opened in the first year, we were named the best new craft brewery in Ontario, and the business has been very successful. And then, quite frankly, I have to tell you, my son's vision of being in Hamilton was the right one. This is a wonderful city to be in. It's changing really significantly, and he was, kind of right about the way that the city is changing, and wanting to be in a city where not only could we have a business, but where that business was a very important part of the community. And they've been really involved in the community all around the Hamilton area with various charities and doing all kinds of stuff. So it's been quite an education for me to see the business grow and to see how it's integrated itself into Hamilton. And along the way, I have to tell you, my wife and I have become we really love Hamilton. I have to tell you,
Yeah.
we have a condo here in Hamilton on James Street, where we've pretty much spent most of COVID time, because I'm working from home here in Hamilton, just because we love the city. We love how accessible things are to do here. We love met so many people and made new friends here. So we've definitely consider ourselves more Hamiltonians now than we do Torontonians. I could tell.
Another Torontonian that came to Hamilton.
Yeah.
And everyone that's on the call just
convert. Yeah.
Pardon me?
Another convert. Yeah.
Another convert. Yeah, he's rising our prices of real estate. Can you believe it? And for all of you that didn't actually hear, I don't think he mentioned it. It is actually Merit Brewing, great company. We love them here in Hamilton. So why don't we jump right into the questions here? I think the one thing that people are talking about is, mortgage rates are down, interest rates fell in March. Up, down, what does that mean for the average person? Why do you touch on interest rates? I know you love talking about them.
Yeah, well, it's pretty clear to us as interest rates. And I think, even prior to COVID, we had been saying for many years that interest rates are going to keep going down. And that was not a consensus view. And a lot of people in 2018, 2019 raised their eyebrows at us going, what, you guys think interest rates are going down? We did say that. And by the way, I'm going to be very clear with all of your listeners. I think interest rates are going to go even lower than they are now. Okay. Now,
oh, wow.
And I'm not saying next week or tomorrow, but I would say in the next 18 months, it wouldn't be surprising to me to see interest rates even lower. But interest rates have obviously fallen based on a very significant, health pandemic that we have and what damage is created to the economy. And, despite the fact that people are, talking about a virus, people are talking about, it's going to go away at some point, or, once the second wave is done, we're done, whatever. We see that there's long-term structural damage, and that's very unfortunate. I have to tell you, it's sad, but there's going to be long-term structural damage from the coronavirus. Not everybody is going to unfortunately get their job back. Not every business is going to reopen, and so that long-term structural damage creates what we call an output gap. In other words, the economy is operating at a much lower level than it was to start with for a long period of time. And if the economy is going to operate at a lower level, the unemployment rate is going to remain quite elevated, then central banks are going to be biased to keep their interest rates low. And pretty, we are at the zero lower bound here, even in Canada this time relative to where we were in 08 and 09. And, it's our view that the central banks are going to have to keep the interest rates this low until the economy fully recovers back. And that is going to be probably 2 to 3 years from now. And by the way, that's not just me saying that. If you look at the guidance and the projections of the Bank of Canada or the European Central Bank or the Federal Reserve in the US or the Bank of England, their projections are all basically saying this output gap, right, and this structural damage that's been created by the coronavirus is going to persist until 2022, 2023. If you look at the US just as an example, the US Federal Reserve is telling you that the output gap and even the unemployment rate, right? I mean, the unemployment rate in the U.S. is around 3.6% at the end of 2019. This morning, we had the unemployment rate in the U.S. reported, and it was 7.9%. So even in the U.S., even at the end of 2023, the Fed thinks that the unemployment rate is still going to be well above where we started from, right?
Wow.
And so therefore, if that output gap is going to persist that long, then central banks need to keep rates this low for a long period of time in order to allow the economy to recover back.
So you said something very interesting there. You said that you think rates are going to go lower from where they are today. Aren't we already almost at zero? Where are we at?
Yeah, well, we're at zero at the front end, as you know, and GICs are a good example of that. I mean, if you look at 2-year Government of Canada bonds or 5-year Government of Canada bonds, they're yielding between 20 and 30 basis points, right? That's like 1/5 or 1/3 of 1%.
Yeah, that's nothing.
Could have never envisioned in our lifetime. But nonetheless, I mean, our general sense is, hey, if this output gap persists for so long, and given kind of what the economy to us looks like, then there's a potential over the next 18 months that interest rates could go even lower, right?
Wow.
And the reason I say that is that it's not just that the output gap has to is persistent for so long, but I think the really important point for people to think about is what is actually going on here, right? Sure, we've had this coronavirus, right? We've had this global health pandemic that's created this very significant economic shock. But even before we had the economic shock, it wasn't that the world was in such a great place. We didn't have phenomenal global growth, economic growth. We didn't have huge levels of inflation, right? We actually had kind of a muddled through slow economy pretty much all the way from 2008, from the last recession, to a year ago. So, and the reason we had that very kind of muddled through economy with slow kind of growth was that there was some persistent headwinds to growth, right? And I want to talk about that just so people understand it. What actually creates economic growth? Economic growth is created by credit growth. People taking out a loan, going and buying something, and then that person who sold that thing has money, and then they go and buy something, and then therefore people are there's a higher demand for goods and services. Well, that credit growth, it's hard to create credit growth when there is already so much leverage. In other words, everybody has so much debt already, right? That you can't create that credit growth. Like we started 2020, before coronavirus, global debt to GDP was 320%. That's the highest in history.
Wow.
And that was before the coronavirus. We've obviously added huge amounts of debt. Companies have, because they've had to borrow to keep operating, right, under very strenuous circumstances. Governments, we've seen our own government in Canada here borrowing more, to obviously help people who are unemployed and have the results of the coronavirus. So we have actually more debt now than we started with. If you have so much debt, everybody's going to be focused on paying it down, not taking out more. Right?
Yeah.
So if everybody's paying it down, that's going to be a detractor from economic growth. Okay, so 3 things really create growth. One is credit growth, the other is population growth, and the other is productivity. So I just talked about credit growth. Well, population growth, world population growth has been declining for 40 years. We're not expecting it to start going up anytime soon. In fact, we're thinking it's going to continue to decline. Wow. And productivity growth, if you've studied productivity growth, productivity doesn't go in kind of a normal cycle. It goes in really, really large waves, right? So you get this, like you'll get something like the railroads way back when, and then you'll get, something like the, technology and computers and stuff like that create a huge wave of productivity for a while. But, so we are in a low ebb of a productivity wave. We don't think productivity is going to go higher in the next few years. In fact, it actually could go lower because, one, if we do get deglobalization from all this trade friction that's happening, right? If companies invest less, right, because of COVID and the uncertain, the very, uncertain, a lot of uncertainty in the economy going forward, those things are actually going to even take productivity lower. So our general view is, hey, credit growth is impaired by huge amounts of leverage, population growth is declining, and productivity growth isn't going up. If those things are the 3 drivers of economic growth, then those are all going to be headwinds to better economic conditions going forward. And so that's why we think we're in this kind of longer term, low growth, low inflation, low yield environment. And that's why I think there's potential for interest rates to go, potentially even lower. Now, having said that, I don't want to depress all of your listeners because they're probably about to hit the stop button or pause button. But what you have to do is recognize what the economic environment and what the conditions are going to be. for both, for the economy and overall, but also for investing. So the first thing is to do is this, hey, let's just recognize what is the world going to look like. And if we think the world is going to look like low yield, low inflation, low growth, then how do we make money? That's the question. And I have to ask myself for our clients, hey, how do we make money in fixed income, right? In bonds when interest rates are so low and they may stay a longer period of time. And that's a question we ask ourselves, and we have lots of good answers to that. So it's not like, hey, we're not going to make any money for clients. We're gonna make, I think, good returns for our clients, even though we are in this low yield, low inflation, low growth period for a long time.
So I think most of the listeners that are listening to you right now, you've been pretty negative. But going forward, how do we take what we know today and how does this change our investment thesis going forward, knowing that rates may get lower? What does that mean for our real estate? What does that mean for all these different things that people think about? A lot of people are saying, okay, the economy is so bad, I should pull my money out, what have you. I should sell my real estate and whatever. But really, if we want to take an educated approach to this, what would you say is a good way to look at going forward and our investment thesis going forward?
Yeah, there's a bunch of things to kind of think about. Just because we might be in this low growth, low inflation, low yield kind of environment doesn't mean that there won't be some things that actually go up in value, right? We have an unprecedented amount. I mean, interest rates are low, as we've already talked about, and probably going to stay low. We have an unprecedented amount of central bank intervention. They're doing all this quantitative easing and so on. There's lots of liquidity that's obviously being provided for the world in order for in order for the world, the economy not to falter and go into a recession. Fiscal policy is also being helpful by governments making sure incomes are supported, right? And by the way, those two things, let's just talk about them really quickly. Why did central banks do what they did? They needed to provide liquidity and to make sure credit kept flowing. That's why central banks are keeping rates low, and they're doing all this QE. And the Bank of Canada, by the way, our own central bank, is really doing a lot more quantitative easing, unconventional monetary policy relative to 2008. Fiscal policy. Why did governments move quickly to make sure that they did fiscal policy? Well, because incomes had to be supported. When everybody lost their job very quickly, right, then you have to somehow provide income support, because if you don't, what happens? You have insolvency, and insolvency is not a good thing. Right? Especially when that insolvency has been created by something that came right out of left field. It wasn't something that we created ourselves, right? Yeah. So that's why all this stuff is going on. So in that environment where, the central bank liquidity and low rates are going to persist, where, we're going to probably have, fiscal policy for some period of time to support incomes, then some things are definitely going to go up. I think it's somewhat supportive for risk assets. So that's in my world. When I say risk assets, I mean things like corporate bonds and high yield bonds, right? If interest rates stay low and central banks are trying to make sure the economy starts to improve, then being invested in corporate bonds and high yield bonds is probably a good idea, because you're picking up extra yield over government bonds, right? Because you get that premium to risk premium to invest in corporate bonds, but and you're kind of getting underlying support, from central banks and so on, to kind of obviously continue to bolster the economy. So in fixed income, rotating into sort of higher levels of risk appropriately, not you have to always be careful how much risk you're taking and what you're being paid to take that risk, which is what we do. We call that valuation.
It looks like you're
sorry. Yeah. Sorry. I'm back.
It's all good.
Yeah. Okay. So we're going, we have to always worry about valuations and how much we're getting paid to take that risk. But nonetheless, in fixed income, shifting to something that's a little bit higher yielding, that's still high quality, is a good thing. I think you talked about real estate. I think real estate is in general, unless we have another, unless we were to hit a speed bump and go into another recession, I think real estate is probably a decent value, or potentially a decent investment in certain places. Equity prices will in general be supported here, so stocks will probably still be okay. Things like gold are a good hedge. Buying gold's obviously gone up a lot, but we think it's probably going to go up more. In fixed income and bonds, inflation. Central banks are trying to create inflation. There are bonds that are linked to inflation. we call those inflation-linked securities. Those potentially are, from time to time, maybe a good investment when I'm managing your money. We have to think at times, I'm saying, should we have some exposure to inflation-linked bonds, which will obviously go up in value, provide not just yield but capital gains as well for our clients. So yes, the environment is very uncertain, and yes, it's potentially going to remain on the weaker side, but that doesn't mean, again, that there won't be opportunities either in fixed income or in other asset classes, to obviously have reasonable returns. The only thing I will say, the last thing I'll just say about that is, in fixed income, I think it's really important that clients think about changing how they look at fixed income. Most people have bonds in their portfolio for yield. They get a bit of yield in their portfolios, and bonds are also good, by the way. And this is what's critical, why you have to probably always own bonds. Bonds are what we call negatively correlated. They usually go up when everything else goes down, so you want something like that. Bonds generally preserve capital. You don't want to lose your money, and in general, they also lower your volatility. So those are all things that are important in terms of why you need to own bonds in your portfolio. But rather than looking at your bond portfolio as just something that provides yield, because yields are so low, we just talked about that, in fixed income, your bond portfolio should be moving away from thinking about yield to what we call total return. Where do we make the most capital gains? Not the yield, because the yield is not very high, right? Yeah. So you have to take the marginal yield you have and generate capital gains to get an overall total return, right? That is actually reasonably decent, even in a world where interest rates in general are low, and in a world where other asset prices, whether that's stocks or anything else, might be a little elevated.
Yeah. No, I think it's so true. And for all of you listening, that's our job. Schick and I sit down with you. We do the asset allocation, and we try to give the money to people that we think can maneuver the ship in these uncertain times. And we use fixed income again, as the ballast to the ship, and that's how we do that. So maybe one more question here. I want to talk about, there's a lot of GIC investors out there, and I think the last time I heard it, there's a lot of money still flowing into money market or cash funds. Yeah. What are you going to tell these people? Is it should people still be investing in GICs going forward? I mean, with the rates where they are and inflation being where it is?
Yeah, that's a real conundrum. The other day I was looking at 5-year GICs from some of the major banks in Canada. I think they're some of them are under 1%, right? Yep. Yeah. So that like earning 1% and locking yourselves in for 2 or 3 or 4 or 5 years is not exactly a great proposition, right? So right now one of the real big challenges is, hey, what is can I find an alternative, okay, to cash where I can get some yield relative to what I can earn in GICs or in a high interest rate savings account, etc. And our kind of view in that is, there's that it's challenging. We ourselves have a fund at Merit. We've run it for 5 or 6 years now. It's we can talk about the name of it specifically if you want, but basically what it is, it was designed for our large corporate pension fund clients, okay, to provide them with something that was yielding better than cash. Because remember, this is not the first time the yield's been close to zero. Remember, in 2009, 2010, they were close to zero too. Yep. And a lot of our pension clients came to us and said, hey, we got to do something here, because when you run a big pension fund, you have to rebalance your portfolio, and often that means you have to have cash for a while, but the cash is earning nothing. So we're getting a penalty having this cash sitting there earning nothing. So find something for us. So we developed this strategy which invests in very, very short corporate bonds. So bonds issued by high quality corporate companies, both in investment grade and high yield. There's a kind of a combination of some high yield, really short dated high yield bonds, really short dated corporate bonds. And what that strategy has done, while being very low, has virtually very low volatility, okay? It's liquid, so you can get your money out anytime you want, right? So that's one of the things you want with cash, is you want to be able to get your money when you want it. And it doesn't have any correlation with anything. In other words, it doesn't matter if interest rates go up or down. It doesn't matter if stocks go up and down. It's just basically harvesting yield from that very short dated portfolio of corporate credit. And that has produced, after fees, by the way, that strategy has produced 3 to 4% every year. Okay.
Wow, that's pretty amazing.
This year to date is up, I think a little bit over 3%. And so after fees. So if you can invest that, to us, that strategy, which we designed many years ago when cash was zero before, is now becoming way more relevant again, right? That's a fund where, if you have cash and you want to obviously get access to it quickly, you are going to still get it above, a yield way better than GICs or high interest savings accounts, et cetera. In fact, I think next year that strategy is still, after fees, probably going to produce 2 to 3%. And think about it, you get 2 to 3%, okay, after fees, and you have liquidity. You can get your money out anytime you want. So if something happens that you want to deploy it somewhere else, you've got access to it. It's not like a GIC where you've locked yourself in. So that's something that we have been talking to a lot of our clients about doing. And the other reason, by the way, Sheehan, that people should be thinking about cash is that typically, and you and your dad have been doing this for a long time and doing it very well. And you often have you have an asset allocation where you might say, hey, well, we're going to have 60% of our clients and 60% of our clients' money in equities and maybe 30 or 40% in bonds. That's been this kind of historic, asset allocation, right? It's a 60-40 balanced fund and so on. Well, when interest rates are very, very low, and I think they're going to stay low, but the risk is still they could go higher. If they go higher, obviously in a bond fund, you lose money. But at the same time, stock prices are very elevated. And in fact, in my mind, they're somewhat dislocated from the economy right now. In other words, the valuation of stocks is way ahead of where the economy is actually operating, right? That there's a dislocation. So stock prices are elevated and there's risk of what happens if, they come down, right? So you lose pretty much everywhere, right?
Yeah,
that's not a good thing. So what is it you normally, so if that 60-40 doesn't make sense anymore, right? What is the asset allocation that might make sense? The asset allocation that actually might make sense, or that I think people should be thinking about, is maybe you need to have more cash. And why? Because cash might, I'm not saying it is, and we can talk about that if you want, might be one of the few risk mitigators, right? Because normally you have cash because you sort of say, hey, I don't want to lose any money, and I just want to be safe, right? So in a world where interest rates might be, kind of potentially unsafe, or stocks may be unsafe, you might want to say, hey, well, I don't want any of that. Where am I going to put my money? And maybe that means that normal 60-40 asset allocation has to change to a higher level of cash. Well, if it has to change to a higher level of cash, which by the way, I don't think is a bad idea, then you need to think about the kind of strategies that I just talked to you about, the one fund that we have. And it's very, by the way, it's very unique. There's nobody else that I know of who has a fund out there like this. We've been running it for, I think, since 2010 now, so it's been almost 10 years old for our institutional clients. And it's now available. About 5 years ago, we made it available for anyone who wants to buy that fund as a cash, what we call a cash alternative or cash surrogate.
Yeah, no, I think it's amazing. Everyone, did you hear that? He manages money for pensions. And this is cash management. So there is an alternative. Most people don't realize that. There's some alternatives out there. Paul, I just want to say thank you very much for coming on the phone today. Every time I have a conversation with you, I feel like I'm smarter. So I really appreciate it. And I know the viewers that are on here today are probably appreciative of that as well. Due to time and because we do these for about 30 minutes, I'm going to sign off here and say again, thank you very much, Paul, for joining us.
Yeah, it's been my pleasure to be here. And by the way, if there's any follow-up questions that you have or any of your clients have, please feel free to throw them our way, and we're definitely willing to answer them and talk about solutions with you guys. But anyways, thanks again for having me. I wish everybody good health and safety, and we are getting the second wave, so please be very vigilant. Together with how you're distancing and doing all the different protocols that are really important right now. And anyway, all the best, and we'll talk to you guys soon.
Yeah, thank you very much, everyone. If you have any questions at all, please get a hold of me, 905-849-3549 or sheehan.patel@nbc.ca. And even if you want to have a call with Paul, we can do that too. All right. See you later, everyone.
Okay. Take care. Bye-bye.